I know we've been watching all this volatility, been concerned about what's happening with some of the stocks. What have you been hearing from your clients?
Well, clients are very focused on the long term. We try to encourage our clients to think of investment horizon as a long investment horizon, not something short day to day. So clients are definitely asking us about what's going on with some of these stocks. A stock that goes up nearly 27 times, nearly 30 times in the span of a month, and then down 60, 70%. So clients are asking us about the impact of these stocks. What does it do for volatility? What does it do for how they should look at their portfolios? Our recommendation to our clients is to stay focused on the long term and to think of their core assets. Since the trough of the global financial crisis, March of 2009, we have recommended clients stay invested. We have not gone underweight S&P 500 once over this entire 12-year period. And so we keep on encouraging clients to just stay focused on that. It's an interesting sideshow in terms of the volatility that we see for a few days, but it does not have a material impact on our clients' portfolios and on wealth creation from our perspective.
That's really interesting. It's been the right call. The markets are higher since then, but we have seen some significant tumbles, including the one that happened last year when COVID hit. The market dropped pretty significantly. Your advice to clients through all of that was just stay invested too?
There are a couple of factors that drive our recommendation to stay invested, and our view is that it's very hard to anticipate certain market moves. So it's very difficult to get out of the market in anticipation of a downdraft, especially when you have a shock like this pandemic. So in fact, during the pandemic, our recommendation was to add to the S&P 500. So starting in mid-February, we're a little bit early, but our recommendation was to add to the portfolio, and then with the rapid increase in the market, we actually started taking our overweights off, but we still recommend clients actually stay invested. If you go back and think about 2020 with the facts, and somebody told you that at the beginning of the year, that we're going to see something like 20 million infections at the time in the U.S. We're going to see something like 345,000 fatalities. Earnings down. At the time, people were thinking before the pandemic up, but then down as much as 20, 30%, and now we're down about 15%, for example, given great fourth quarter earnings. And people gave you all those facts. GDP down 3.5%. Who would have thought the market would be up 18%? So the message to our clients is that it's hard to anticipate how the market might react to certain news. So unless there's very compelling evidence we're going to go into a recession, the bias should be to stay invested, and if things start getting cheap, then to go overweight.
You know, that's really interesting. There are a lot of people who think what we've seen with the retail investors, with some of those stocks that you mentioned at the top, up by 1,000% or something in a matter of weeks. There are some people who would say, wait a second, these are signs of a bad turn coming. You think it's just noise. Why is that?
Yes, exactly. We think this is noise, and one should focus on the signal. The signal is this incredible earnings. The theme of our outlook for 2021 was U.S. resilient. And we're trying to give clients the message that, first and foremost, U.S. preeminence is intact, and that's been a 12-year investment theme. So core assets in things such as the S&P 500 and more assets in the U.S. than elsewhere, and then stay invested, and then U.S. resilience. And when we're thinking about U.S. resilience, we think about the diversity of the economy. We think about the incredible corporate management quality. Earlier, you were talking about various amazing corporate CEOs and corporate management in the U.S. that has been ranked the highest in the world by independent third-party academics. And so when you're looking at all this, the key driver of a client's portfolio are going to be core earnings. It's going to be what market expectations are in terms of valuations. So when you're looking at these other factors, they do contribute to small interim volatility, but it's a small part of the market. It's not a big part of the market. So again, staying focused on core assets rather than these more volatile issues that eventually correct themselves when a company's price is so separate from underlying fundamentals. Eventually earnings and prices do converge, and that's the key message for our clients.
Shepard Smith here. Thanks for watching CNBC on YouTube.